Hello, this is Stuart, and in today's module I would like to talk about a very important topic of setting initial stop loss points. Now ideally when we're trading we should be setting these points before we enter the trade, with the whole premise being that if we enter the trade and it doesn't move in our anticipated direction, we're in a position to cut the trade, realise a small loss and move on to the next trade. Now specifically with this module I'm going to be referring to medium-term trading, medium-term trends, and very shortly we'll cover more shorter-term trading, whether it be with stocks but also with foreign exchange, and we'll see the very subtle differences on where we place our stops when changing the time frame, because they certainly need to be set differently. So what we're doing here is talking about where we put our stops, ideally before we enter the trade. So when the trade doesn't work in our direction or move in our direction, we're in a position to quite unemotionally and very much just following the process of having our stop triggered and making that decision to exit. Now I cannot overstate the importance of setting stops and then sticking to them. There's probably not a more important time-tested trading rule than cutting your losses or cutting or losing trades. And I thought just briefly before I started this particular module, I'd bring in the assistance of a couple of traders who were interviewed in the original Market Wizards book by Jack Schwager. And the first one is Ed Sekoto, who when interviewed said, "The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance." Marty Schwartz, also interviewed in the Market Wizards book, said this: "Learn to take losses. The most important thing in making money is not letting your losses get out of hand." I think many of us can relate to the situation where we've entered a trade in the past feeling very optimistic and confident, it's moved against us and we've been paralysed and not being able to make the decision to get out, only to see the price continue to fall and fall and fall, feeling helpless, frustrated, angry that the price has moved well below where we entered. And of course when we think of that situation, as the price moves further and further away, the decision to exit that trade does not get any easier. In fact, it only gets more difficult as the price moves further away. So the easiest it will ever be is when we are back right at the beginning, when the price just moves down a little bit to our initial stop loss point. That's the easiest it will ever be to cut that losing trade. But again, there's probably not a more important time-tested trading rule than cutting your losing trades, cutting your losses, and you cannot overstate the importance of cutting losing trades. What I'd like to talk about today is, as I said, just a few different methods of setting stop losses, and I thought probably the best way to do that is to really just bring up a few random charts that I've actually literally just opened up a few minutes before recording this, and just really quite raw, just look at the charts and talk through what I would look at, talk through the different methods of how we can set initial stop losses if we were trading these as medium-term trends. And remember, as we talk throughout this, please believe and please convince yourself of the importance of cutting losses, setting stop losses, because at the end of the day, stops and setting stop losses are essential as an essential part of your survival as a trader. And as a trader, you need to survive. And the longer you survive, the more chances, the greater probability that you'll achieve long-term success, you'll achieve long-term consistent results. So setting stop losses is probably the most important part, and it's certainly an essential part of your survival as a trader. Okay, the 3 methods I'd like to talk about today are technical stop losses, placing our stop loss points based on our technical analysis of the chart that we're about to trade, volatility, in which I'm a big fan of, and I use average true range to measure that volatility. And in the notes for this module we'll place some instructions or place some information on average true range and how it's calculated. Most charting applications include an average true range indicator, so it's not information that's difficult to obtain. And as I said, we'll certainly include that in the notes for this module, how you can calculate the average true range. And the other one is probably the most simplest way of setting a stop loss point, and that's to simply take off a percentage off the entry price. So literally just setting a percentage fall, and should the price fall down X percent, let's call it 8 or 12 or 10, that's our cue to exit the trade. So what we'll do now is look at this first example here. Here's a company where the price is $2.03, just broken through that key level of $2. Now if I was to apply the simple percentage fall in this particular scenario, I think 10% for medium term trading is a very good rule of thumb. It's certainly easy to calculate and probably a reason why it's popular with people. Very easy to calculate to take 10% off your entry price, and in this particular case an entry price of around 203. Of course you're looking at 20 odd cents, easy to take off, and that would bring us down to around the $1.83 sort of level. Now if I just placed a very simple line at around $1.83 just like that, would we use this as an initial stop loss? Well, I think in this particular case it works out quite well, because I would identify this area through here as certainly a likely support level where it's been able to bounce off and find support there and then move strongly off. So by putting my stop here at $1.83, it's just getting underneath that sort of level there. Admittedly it has a couple of weeks ago fallen a little bit below that, but it certainly moved strongly off that level, the only sort of green one in there. It moved strongly off that level and then has moved since. So that sort of level there I think is probably an appropriate stop. Again, for protection, obviously the further away you move your stop, the less likely you are to be stopped out. However, having said that, when we position size correctly, the further away we place our stop, the fewer shares will be permitted to buy, because clearly the further away we move our stop, it's intuitive to think that you're going to lose a lot more money, but of course that means we actually buy fewer shares, we position size accordingly. So it really doesn't matter where we put our stop, we base our position size exactly on where we place that stop, and we'll talk about that a little later on. If I want a little bit more protection, I might identify this low level here as $1.79.5, and certainly $1.80 is likely to be a key level, and I may choose just to move that down to $1.79, which not only gives me the 10% sort of fall plus a little bit, which is fine, it also just gets me under another sort of key support level, and I think in that situation that's an ideal initial stop loss for that medium term trade. Because at the end of the day, what are we trying to do? We're trying to identify a level that if the price fell down to there, let's say in that situation there, would you still want to be in the trade? And I think you could argue after this sort of support breaking higher, if it moved all the way down to this horizontal yellow line, the $1.79 level, would you really still want to be in the trade? And I think you could argue that you wouldn't want to be in the trade. So that's probably an ideal sort of point to place at. Now also in this situation, I could find out what the volatility is, and I'll just apply my average true range indicator onto this chart. Now that blue line has no relationship whatsoever to where the chart is, but I'm just going to find out that it's about 7.5 cents. So I can, what that tells me is on average this particular stock moves around 7.5 cents per day. Now I can use that information and tailor my stop using that information, knowing that on average it moves 7.5 cents a day. Now if I put a stop loss from 203, 7.5 cents down, we're probably around $1.95-ish. Would it be appropriate to place your stop loss only one average trading range day away? And I would argue no, because in every single uptrend there's always times where we have downtrends, and we don't want to be in a position where the very next day we're out, even though it's still within the medium term uptrend and we haven't achieved a lower trough. So you can probably just see from that simple example, placing your stop one average true range away would not be very appropriate. So what if we put it two away? That would be 7.5, that'd be 15 cents. 203 minus 15 cents is probably around $1.88. Oops, so I'll just simply move this down to around $1.88, so we're down around here somewhere. And you can do a lot of testing yourself on this if you wish, and I've certainly done a lot of testing. And when I was first introduced to average true range, I remember someone saying 2 multiplied by the average true range is probably the best for stop losses. So of course I used that, and it didn't work for me. And so I did a lot of testing several years ago now, and I found that above 3 is probably a lot better than anything below 3. So even if we move that 3 times the average true range, which we're now up to 21 cents, we're right back down to that sort of $1.80 level down around here, which is probably very similar to where technically we'd place a stop, and also, you know, a rule of thumb 10% fall. all around the sort of same level. And I guess that just sort of adds weight, doesn't it, to where you would perhaps set this initial stop loss. And I still believe around the $1.80, perhaps just a little bit lower, around the $1.79 would be an ideal spot to place an initial stop loss for this medium term trade. Okay, let's just go to the next one. Now I've just already done something here, and I need to move you up here so you can see this. This is again another good solid. You can see it all throughout here, a good solid medium term uptrend. And here we are in a position now where we're at the 49-cent level, certainly a level of resistance because it's moved up against there for the last week and failed to get through. So again, let's think of some technical levels. Let's think of a percentage fall, and let's think of average true range. From a technical level, I see this sort of 47-cent level. See how it's been resistance, again resistance, and once broken it's become support. So if we were to look at to buy here, if it broke to 50 and put our stop not at 47 but maybe 46.5, 46. So again, let me just draw that in for you, maybe at 46. What are we doing here? Well, if we got in at 50, 10% off 50 is 5, so that's at 45. Technically, I think that would be a good level because if the price fell from 50 down through there, it'd be breaking through this key support level at 47 cents. So I'll just get rid of that. So again, probably I wouldn't want to be in the trade. And the other one, of course, is the average true range. So again, I'll just find out what the average true range of this stock is. And right now, the average true range of that is 1.6 cents. So again, if I was to multiply that by 3, we're getting to say 4.5. Again, just adding weight to the fact that if I put this at 4.5 minus a 50, around 45.5, that sort of level, again, we're all sort of coming up with a very similar level. The 10%, of course, would be 45. The average true range would be 45.5, and technically, I'd probably put it at 46. So certainly around there is somewhere where I'll be putting my initial stop loss level. Okay, again, using the 3 different methods on the medium term trend. Now, what you just saw before as I put the chart on was, in fact, as I said, I just looked at these charts just a few minutes before I recorded this video, and I put on what I use for my trailing stops, which is not what we're really talking about now, but I actually found out, and I'll just show you this, that this blue line here represents how I trail my exits on my medium term trades, and we'll talk about this a little bit later on. And you can see how well that blue line has sort of just stayed far enough away from the medium term trade, and it's done a really, really good job of capturing an entire move up and literally just staying away. Now, how this calculates the distance, you know, where to put this blue line, is in fact based on average true range. And what we do is we take the average true range, which in this particular case is 1.6 or so, and we multiply that by 3.5 in this particular case to work out this blue line. As I said, you can just sort of visually there see what a great job it does of just staying far enough away from the trade. So if we were to use that as initial stop loss now, you know, we're certainly putting our stop a little bit further away, down at 43 cents. But of course, there's nothing wrong with setting an initial stop loss based on a technical level. Let's put that at 46. And then once the trade progresses, adopting a volatility-based trailing exit sort of approach. I don't think there's anything wrong with that at all. As long as, of course, you're clear on where they transition, where we stop using this 46 and the trailing sort of takes over. And it might be just simple as, you know, there's our 46, and we put on our, I'll just put on that blue line again to give you an idea of where that would be. We might be in a case where we start with our 46, and as the price moves higher, of course, this blue line is going to come higher up through here, and when it overtakes that 46, guess what? The yellow line doesn't exist anymore, and we now follow the blue line throughout the trade. Might be just one way of doing that. Okay, let's move to the next stock. Have I shown you this one? No. So let me just move down to this one again. Why has this come up? Just a good sort of, for a few months here, good solid medium-term uptrend there. And again, where we position now, we'd probably want to break through the $1.35 to get an entry into this stock. So where would we put our initial stop loss based on those various methods? Technically, we've identified this level here as the sort of previous, likely to be the previous trough. It hasn't certainly formed a trough here at $1.27 or so, but if we have a good couple of sort of solid up days here to continue and break through this here to get us into this trade, this would therefore be a trough, and we could place our initial stop loss just below that trough. I'd probably identify $1.25 as a key level, so I'd probably just want to get under that a little bit. So let's put that at $1.24. So if we got an $1.35, I think technically you could put a stop just down here somewhere. Yes, there's nothing wrong with moving it down below this sort of level here, or even more so down here. But then again, when you think in percentage terms, we're now looking at certainly a 30% fall, which is a lot to give a stock back to say, hey, yes, we got it wrong. So I think probably even just a little bit tighter than that. If we worked on the 10% rule, we'd be taking 13.5 cents off this entry price, which would bring us down to a dollar. Trying to do my maths here, about $1.21.5. So again, in a similar sort of position. And again, let's just go to the volatility to see how that suits. And we'll just find out what the average true range of this stock is. And right now, the average true range of this stock is 5.5 cents. So again, if I use that 5.5 cents and perhaps multiply it by 3, that's getting me into the 16.5 sort of cent level, which would bring me back down to the $1.19 level around there. So again, just providing me that extra protection of perhaps the $1.20 being a nice little sort of round number. It's certainly providing me protection from this trough here. It's a little bit more than 10%. I'd be inclined probably just put a little bit closer than that. But that's again just where we'd set our initial stop loss point. Let's go to another one. Here's a stock that's been going very well. Why has this come up? Well, you can see why. Because over the last 6 months, it's cruising very, very nicely. So again, where would we put our stop here? Well, in this particular case, I'd want to see a break back through this sort of level here to get back into the medium-term trend continuing along. And let's say we got in at the $2.95 or even the $3 level. Let's say the $2.95. Technically, once we formed a trough, hopefully around this level, assuming the next day does this and the next day does this, I would identify this as the trough. Certainly the low point I'd be very interested in, and I'd very quickly just put a stop loss below that level. And if we got in at 295 down to 260, that's certainly a little bit more than 10%, but I'll be comfortable with that, because no good putting my stop in at 10% when it's right here, and it's very likely to come back down again and touch that level but still be within the medium-term trend. In other words, the conditions while we got into the trade still exist, but it's fallen 10%, therefore we've got out. So that's why I don't think necessarily a 10% is a great rule, especially if there's additional volatility within the stock. And I'll just find out the volatility of this stock right now. And right now the volatility of this stock is 11.3 cents, which is actually reasonably high. It's when I say high, I say 11 cents on a $3 stock is doing some quick math here, but it's certainly around 3%, which is quite volatile. So if I take that 11 cents, I can multiply that by 3, which is around 33 cents. And yep, would probably get us, if I got in at 295, back around to that 260 level, which is probably where I'd want in the first place. Okay, a couple more I'll look at. Here's another one. Again, this is another one that's been cruising and doing very well over the last 6 months. And why are we looking at it now? Well, because it's going up. And furthermore, I just notice here, just very quickly, you can see very much an ascending triangle forming there. Can't you see that? Right, a very good solid ascending triangle where we're belting a hit up against this sort of $4 level, but at the same time the demand is becoming quite aggressive. We're very keen on pushing the price up higher in this particular stock. So we've identified this ascending triangle. My scan didn't identify the ascending triangle, it just identified the fact that it was going up. But let's say we wanted to buy on the break of that $4 level, which I think is a very sound reason to get into this particular stock. Again, technically, you could easily place your stop just on the other side of the triangle. We call this the hypotenuse, I think someone taught me in the mastermind. Just on the other side of that triangle. Again, let's just do some maths. 10% of $4 is 40 cents, which brings us down to that sort of 360 level. If I work out the average true range of this stock, I'll find out that it is just died off a little bit lately, but it's still 14 cents. So again, if that 14 cents multiplied by 2 is 28, multiplied by 3 is 42. So again, they're all sort of giving me an idea of around that 360 level, which I think technically is a great spot, because you wouldn't want to have the price breaking back down to there, because it's certainly the reason why we got into the trade to break higher from this ascending triangle. I mean, I don't see any reason why it doesn't come back just down in below that $4, but it certainly should maintain its position above this sort of great demand and support throughout here. and if it broke right down to that sort of 360 level, you would be enough to be convinced that the reason why we got into the trade, again, simply don't exist. One more for you, a couple more for you. Again, this has come up my scam because, no surprises, it's going up. It's been going up quite well. This is probably a little bit trickier because this last leg here has been quite a big extension, from 350 up to sort of 440. 90 cents on a $4 stock is quite a big percentage move. But again, I'd be looking for a break through this 440 level. A 10% rule would have me just below the $4 level. So the 45 cents off 450 would bring me back down to 395, which again, just below a key level of $4, I think is an appropriate level. Technically, again, I think $4 would be a key level. We notice there's a bit of resistance here. There's been support there at $4. Again, so if we place our stop just below $4, I think that would be appropriate. Of course, there's nothing wrong with placing your stop way down here, at this sort of level here, but bearing in mind, you're just going to be buying fewer shares. The position sizing is going to say, no, you can't buy as many because your stop is so far away. So just be aware of that. There's nothing wrong with putting it there. Certainly you've got a less chance of being stopped out, and certainly if it did come down to there, there's no way you'd want to be in the trade any longer. I'll just do the average true range, check the volatility, and we can see the volatility on this stock is, let's call it 18 cents. So 18 by 3 is, got me there, 18 by 3, 36.54. So 54 cents off the 440 again brings us back down below the, certainly well below the $4 level, way back into the 385 level. So certainly somewhere in that 385 to 395 level I think is an appropriate stop for this stock for that medium term trade. And we'll go for one more, and this is a little bit messier. Again, it's come up because it's moved solidly all throughout here. However, having said that, the last couple of months hasn't done much at all. So obviously I'd be looking for a break of this sort of level up through here, the 450, 455 level. I wouldn't want to get into it before that. So again, a 10% on that would bring me down close to $4. I'd probably want to just touch below $4. It gets me below this trough here, but not below this trough. The volatility on this stock is, you don't even see it because it's way down below the screen there, but I can tell you it's 16 cents. So again, 16 by 3, 32.48. So again, it's around that 45-50 cent level. Again, it brings us back down to around the $4 level, somewhere around here. I'd be comfortable with it, I think. I'd certainly probably just want to push it a little bit lower than that, just aware of the fact that $4 is just a nice round number and prices tend to congregate around round numbers. So there's just a bit of a feel for just a few stocks. I think I started with that one. So I've gone through about 10 there, and as I said, I actually just before recording this, I just did a scan of just what I look for in my medium term trades, and just really from raw, without really looking at them in great detail beforehand, just looking at as I would look at them, and just to give you an idea of the sort of methodology I would go through to identify suitable initial stop loss points. Remember, the three that I talk about often are a technical stop loss, a volatility based using average true range, albeit you can use other volatility measures, but I think average true range is very popular and certainly very easy to find. And the other one, of course, the easiest to calculate, I believe, is the percentage fall. Just simply, 10% as a rule of thumb off our entry price. But if I can just sum up with a few things, you can never overstate the importance of setting stops. Remember what Ed Sekoda said. It's pretty plain, isn't it? The elements of good trading are 1, cutting losses, 2, cutting losses, 3, cutting losses. If you can follow these 3 rules, you may have a chance. Marty Schwartz said, learn to take losses. The most important thing in making money is not letting your losses get out of hand. Isn't that ironic? We all trade to make money, and it's unfortunately our primary focus until we shift that. But the most important thing in making money is actually nothing to do with having profitable trades. It's everything to do with having losing trades. Right? The most important thing in making money is not letting your losses get out of hand. And we've all, who have traded, been in a position where we've had a loss get out of hand. We've all had it. We've all gone through it. And it's so important now that we do everything we can to eliminate that happening ever again. Setting initial stops, getting confidence in those, and then executing them and implementing them certainly allows you to get out of those losing trades. And as I say to so many people, I love getting out of losing trades now. It's almost a sense of relief when I get out of a losing trade, because I've denied myself Yes, people say, oh, you can't get break, you can't break even. You've denied yourself the opportunity to break even. But to me, more importantly, I've denied myself the possibility of actually losing more money in that trade. And we all know the devastating effect just one or two massive losses can have on our confidence, on our emotional state, but of course, most importantly, on our account balance. So to me, it's a sense of relief when I get out of a losing trade, because I've denied that possibility of losing more in the trade. I love that certainty of that's it. I love the certainty, and I appreciate the fact that they are very much a part of trading. And I have, in fact, I have probably more losing trades than I have winning trades, and I very much accept that as a reality, and the fact that it's a very much a part of trading. So ideally, we set our stops before we enter. But if using a percentage, it might be wise to identify exactly, sort of entry level, if you want to be that precise, to determine that sort of exit level. And ideally, we get out of a stock, we get out of the trade when the conditions while we entered the trade no longer exist. In other words, why would you still want to be in it if the conditions that you base your entry decision on no longer exist? Okay, so can't overstate the importance of them. They're an essential part of your survival as a trader, and that's what we need to do. We need to survive as a trader. The longer you survive, the greater probability you'll have of achieving long-term success. Now remember, just to finish off here, this was simply for medium-term trends. Very shortly, I'm going to do a similar video for short-term. We can look at short-term trading of stocks, but I'll also look at foreign exchange as well. If you're interested in trading medium-term trends, which I think a lot of people are quite interested, of those technical volatility and percentage, which one do you think you prefer? Do you see advantages and disadvantages with any of those? And how do you think you will set your initial stop losses? Please post your comments below. What do you see as the advantages and disadvantages of each of those methods? If you have any comments about any of the examples I've shown you here in this video, please comment. And also, more importantly, how from now in your medium-term trading are you going to set your initial stop losses?